Refinancing your mortgage simply means replacing your current mortgage with a new one. Most people refinance in order to lower their interest rate, reduce their monthly payment, shorten the loan term, remove mortgage insurance, access equity, or some combine all of these. In this video, we'll walk you through the most common refinancing strategies and when they actually make sense. Refinancing is usually much simpler than purchasing a home. There are fewer parties involved, fewer moving parts, and in most cases, lower overall costs. Because of that, refinancing can be a very efficient financial move when structured correctly. The most common reason to refinance is to lower the interest rate, which can translate into monthly savings, long-term interest savings, or both. If you bought or refinanced when rates were significantly higher, refinancing is absolutely worth exploring. A common question is, how much lower does the rate need to be for it to make sense? My general rule of thumb is at least a half a point reduction, but that's not a hard rule. The real answer depends on loan size, closing costs, monthly savings, and how long you plan to keep the loan. We always look at the break-even point, how long it takes for the savings to outweigh the cost of the refinance. This can vary on how the refinance is structured. It may not always be strictly based on monthly savings. Many borrowers refinance from one 30-year fixed into another 30-year fixed. While this often produces the lowest possible monthly payment, it may not be the most financially efficient option for a cash flow perspective. Most lenders often offer flex terms. For example, if you took out a 30-year loan 2 years ago, you could refinance into a 28-year fixed. This prevents resetting the clock and pushing your payoff date further out. It may also make sense to consider a 20-year fixed or a 15-year fixed. Shorter terms usually come with lower interest rates and significant long-term interest savings rather than a monthly decrease in payment. If you currently have mortgage insurance, refinancing may allow you to eliminate it depending on your current loan balance and the current value of your home. Removing mortgage insurance can result in immediate monthly savings on top of any rate reduction. We cover mortgage insurance in more detail in another video on our channel and website. One of the most common and misleading sales tactics is being told you get to skip 1 or 2 payments. You never skip mortgage payments when you refinance. Here's what actually happens. Interest and principal are included in the payoff of your current loan, and prepaid interest is collected on the new loan at closing. Because mortgage payments are made in arrears, your first mortgage payment on the new loan may not be due for 1 or 2 months, but those payments are still accounted for in your payoff and prepaid interest at closing. Another term you'll often hear is a no-cost refinance. They usually work one of 2 ways. Number 1, you accept a higher interest rate and the lender uses a credit to cover the costs. Number 2, the costs are rolled into the new loan balance, resulting in the new mortgage balance being higher than your current balance. Both are valid options, but neither means the costs disappear. Always ask, how is the loan being structured? Am I paying with the rate, loan balance, or out of pocket? I typically show clients multiple options. Paying costs out of pocket, options with lender credits, rolling costs into loans, or hybrid approach. The best option depends on your comfort level and time horizon. There is no one-size-fits-all. However, something to consider is that if you are accepting a higher interest rate in exchange for lender credits to offset the costs, keep in mind that you are financing the cost of that higher interest rate. If you prefer to limit your out-of-pocket when refinancing, consider rolling costs into the loan and going with a lower interest rate option. You are still financing costs, but at a lower interest rate. With a standard conventional rate and term refinance, the maximum cash you can receive back at closing is usually about $2,000, and that's only after paying off the current loan and rolling in costs. If you want to access more equity, you're looking at a cash-out refinance. For a primary residence conventional cash-out refinance, the maximum loan-to-value is typically 80%. Cash-out refinances often come with higher interest rates, but they can still make sense, especially for debt consolidation. Paying off high-interest credit cards or personal loans can significantly reduce monthly obligations, even if the mortgage rate increases slightly. You may also want to consider a second mortgage option rather than refinancing your current mortgage. We have another video on HELOCs and second mortgages you can check out on our channel. If you currently have an FHA, VA, or USDA loan, you may qualify for a streamline refinance, as long as you're staying within the same loan program. Streamline refinances typically require no appraisal, no income documentation, and a mortgage-only credit report. They're designed to reduce your rate or payment with minimal friction, though there are eligibility requirements that must be met. Another common reason to refinance is to remove someone from the loan, such as in a divorce or separation. If one party is being bought out, this can often be structured as a rate and term refinance, not a cash out refinance. That distinction matters because rate and term refinances usually offer better interest rates and they allow for higher overall loan to value. Refinancing can be a powerful financial tool, but only when the numbers actually make sense. The key understanding is the structure, the trade-offs, and your long-term goals. If you found this video helpful, we'd appreciate if you subscribed and follow us on social media for more clear, practical mortgage education. Thanks for watching.